All right, what is up, traders? What's up, tycoons? Super excited for today's video. This is probably going to be one of the most important videos that you watch for the year of 2024. And I don't say that lightly, okay? We're going to break down why it's going to be so important, and you're going to want to refer to this video months and months later into the future. Even at the end of the year, you can come back to this video and it will be really useful and great to come back to. So as we know, the S&P 500 hit record highs. What does that mean? So we're going to take a look at, what does it mean actually when the stock market hits all-time highs? Is that bearish? What's the average performance at? So we're going to look through many charts going over the actual historical data of what it means when we hit all-time highs. Not people guessing, not people saying that we're going to go to the moon and just saying that, not people saying that all-time highs is bearish, right? We're going to go through actual real data. On top of that, we're going to throw in some seasonality. Now, my favorite seasonality is the election cycle. So we'll break down election year seasonality because obviously there's 4 years in the election cycle for the seasonality. And right now we're in the actual election year. Midterm election year data and pre-election year data were amazing. And since I've been incorporating this into my thesis, it's really helped to give me an edge. So I'm going to share that with you guys. We'll also take a look at February performance as we're heading into February. And then what we're going to do is actually go back and go over some of the previous data that I've given you guys and see, whether that data was right and whether it was a good signal. So we're going to look at some of these old signals that I've shared before and go over how it's played out currently in the market. As always, though, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And if you're new to the channel, I started a completely free newsletter for you guys. It's called Investment Intelligence, giving out free, valuable finance content. And I try to sprinkle in like 1 or 2 free trade ideas a week in there. And these are what the trade ideas will look like, highlighting the conditions on the chart, showing you the chart itself so you know that we're looking, what it is that we're looking at. And you can go back and review the website, okay? Because there is a website with it. And remember, it's free. So you can go back and see some of the previous trade ideas. And many of them have worked out very, very well. Reason being is because I really look for high quality setups rather than spamming you guys every single day with a ton of different trade ideas, just trying to brag about 1 or 2 that work. Now, RTX was one of the recent ones that came out at the end of December, heading into January. And, that play was very, very well. You can see people in the Discord actually messaging me about it. So you can join the Discord right now. Okay, now we were running a promo code Jan24 to celebrate the new year, but that's ended. So if you missed out on that, it was only $1 to get into the Discord. But for right now, it's back at regular prices of $10 a month. So think of that. That's less than a cup of coffee a week. And you can see some of the profits, that traders are posting in the Discord. Really, really nice moves. So if you want access to all the different analysis, over 20 plus swing trade ideas a day, or every week. And then also all of my intraday updates that I'm looking at for day trading and scalping opportunities, as well as being able to see things like gamma levels, dark pool levels for some of your stocks. Join the Discord. It's a really great opportunity. Now, all-time highs, January 19th, stock market hit all-time highs. So let's talk about that. Okay. And if we look after stretches of over a year, we see that on average, the stock market 12 months out is up 13% of the time. Okay. And out of all of those historical data sets, 92% of the time, the average is positive. Okay. Or the market returns are positive. So what we're looking at right now suggests, okay, that we have a 92% chance of being bullish this year, meaning that, we're going to end the year higher than all-time highs. Okay. Now, whether or not that's going to be true, okay, we'll have to see. All right. There's always that saying, this time could be different. But, those are some of the most dangerous words when it comes to investing. And so rather than just trying to guess and, give my opinion on everything, I really just try to look for historical data and share that with you all. And so, 92% chance of us being positive is very good. And I really like those odds, and I'm willing to trade and kind of invest based upon those odds. But let's go further, right? And this is a line chart. So this is the S&P 500 average performance the year following new all-time highs. And you can see that this looks great. Okay, we're right here in the very beginning part of this. Okay, you see it's a little choppy here, but overall on a 1-year performance, it's bullish. Okay, again, that's historical data. Now, this is a table chart. going over what's in this data set right here that makes this line. So if you want to take a screenshot of this and kind of just refer to it or something like that, I know some of these images won't have the best clarity, but that's because I had to blow them up for you guys. So, just bear with me. I'm trying my best to share really good data with you guys that I'm finding. All right. Now, why are we even at all-time highs? Like, what's going on here? Well, we see that venture capital investments by Microsoft, Amazon, AWS, NVIDIA, Google, these are just absolutely skyrocketing. Okay. If you take a look here, $25 billion in 2023, and I imagine that that is going to continue rising. Okay. It's going to continue rising higher. And the reason that I think so is because companies are just now starting to understand the capabilities and the enterprise value that AI brings. We're seeing lots of these top companies and tech companies reporting layoffs. And the reason for that is because they're trimming the fat on some of these unnecessary, things that they were prioritizing and focusing on in the past. And what they're doing is they're realizing, hey, we can just spend more money on AI and figure out, how to, really capture the enterprise value that AI is bringing. And so we'll spend more money on that. And the money we're spending on that is going to be from, laying off employees and things like that. Now, of course, layoffs, they suck, and it definitely sucks for those people. But a lot of these people working at the top companies in the world, they are very smart, and I'm very confident that these people will be able to find other jobs. Now, it may not be the job that they want, okay, or paying more than what they were getting paid. But, these people will find work out there. And, as we mentioned, January 19th is when we came and hit a record close on the stock market. And so if we go back to that date, NVIDIA and Microsoft had accounted for about 75% of the S&P 500 gains in January or in 2024, while the 20 largest stocks in the index accounted for 110% of the index's upside move. So what does that mean? Well, that means that the remaining 480 stocks were actually acting as a drag. So there's this thing that everyone talks about and really gained a lot of attention in 2022 and 2023. And that was that, hey, it's only the top companies, it's only the best companies performing and carrying all the gains. The other, 480 stocks in the market, they're not doing well. And people will tell you that this is bearish, okay? But this was on January 19th, where the other 480 stocks were acting as a drag. And what have we done since January 19th? Well, we've continued to make more all-time highs. We just had a record close in February here, in the beginning of February on Friday, for all-time highs in the S&P 500 again. And so when you really account for it, okay, and you can just go back and take a look historically, all right, look at the RSP, that is your equal weight S&P 500, and then take a look at the SPY. And when you see the RSP outperforming the SPY, well, that's a bad sign, and we're usually in a bear market. Now, why may that be? Well, because in bullish times, the best companies in the world, remember, the S&P 500 is compiled of the top 500 companies in the world. And so in bullish times, the top 20 companies of the top 500 companies in the world are going to be performing very well. And their market caps and everything is just so much bigger that they're going to be moving a lot of the weight. And so, while a lot of the other stocks are dragging a little bit, so to say, it's very common for you to see strength in leadership in the top, names during bullish cycles. So it's actually bullish to see these stocks outperforming, okay? Just the same way as it's bearish to see those stocks underperforming. So when 2022 is a great example, right? A lot of these names went down 30, 40, 50, 60%, you know what I mean, from their all-time highs. That was a completely bearish time. Meanwhile, the RSP wasn't down that much. The RSP wasn't down 40, 50% like stuff like Meta or Netflix or Amazon were. And, you don't hear anybody saying, well, we're bullish. The RSP, the equal weight's performing a lot better than the top 20 names. We're seeing the other 480 stocks carrying their weight, holding up a lot better than, the top companies. Nobody says that that's bullish, right? And so that's something that you need to keep in mind, is that, historically, you've always seen the top companies driving a large percentage of the gains in the SPY and in the S&P 500 because it is market cap weighted. Now, enough about that. we just had the largest weekly inflow to tech funds since August 23rd. Now, this data set is about a week or two old, but I presented it to you guys when it was when we saw it, right? And when we found out about that. And what did we just have? Very shortly after that, a week after, we had the QRA, the quarterly refund announcement in the treasury. And I told you guys that this was going to be a market mover. I told everybody on Monday last week, hey, this is going to be the big catalyst, and it could really drive direction in the market for the next few weeks, for the next couple months. We take a look, and we see here the QRA, back last year in August, it really started the sell-off in the S&P 500 and really started the rally in 10-year treasury yields. And then the Q4 QRA was actually bullish, and we actually saw stock market gains go on a tremendous rally from there and really fueled that November, December, January rally, one of the most bullish 3-month rallies we've ever seen. Was fueled in part by the QRA, and we just had the QRA on Monday. And Monday, all of a sudden, we just saw a huge squeeze in the market, and in stocks just completely rallied after we had that QRA. And I hope a lot of you guys were prepared for that and weren't caught on the wrong side of the trade. I was telling people, hey, just wait for the QRA, see what the market's reaction is, and read about it. Don't try to guess into it ahead of it and try to predict that it's going to crash the market or send the market to the moon, because you don't want to be caught on the wrong side of that trade. Now, new all-time highs do happen a lot. And if we look at this data set right here, all of the green lines right here, or green dots, are going to be new all-time highs. And if we take a look, all right, at the 1-month return, 3-month, 6-month, and 12-month returns, they are all positive on average. The median is all positive, and it's really, really great. Now, when you break it down a little bit more and you look at the percentage of times that were positive, so the times where we hit all-time highs, and then what happens 1 month, 3 months, 6 months, 12 months out after, well, the percentage positive on 1-month returns is about 60%, but the further you go along, it's more positive, right? So 3 months out, we tend to be at a higher price 67% of the time. 6 months out, we tend to be higher 72% of the time. And 12 months out, we tend to be higher 70.8% of the time. So this is why I said you're going to want to come back to this data set and realize that, hey, each time we make a new all-time high, then you can come back and look at this and say, well, historically, the 1-month returns, 3-month returns, 6-month returns, and 12-month returns, these are kind of what I can expect. But in the beginning, the data set that we had was more bullish than that, right? This says 12-month returns, the percentage positive is 70% of time. This is after every single all-time high that we've ever made, okay? Taking that data set into conclusion. But this is the one that we went over in the beginning. This is the first new high after 1 year bullish going forward on average. So we had a bear market, okay? And then we had 1 year of bullishness, right? And we hit all-time highs. So this data set right here, the percentage positive, 92.9% positive, okay? The mean returns on a percentage is 14%, and the median is 13.4. So could we expect possibly to see 13 to 14% gains in the stock market with about a 92% chance of that happening? The data says yes. History says yes. Now, numbers don't lie. Okay. And that's a common quote that you hear people saying, and I'd much rather trust the numbers and go off of the data than some guy on YouTube saying that all-time highs are going to start a crash. Okay. Of course, we can always have a crash. All right. That's, there's always the chance of a black swan event. Anytime we've ever had a recession during an election year, we've had a bear market. So, it's not 100% guaranteed, right? And it says that, but the odds are just so much in your favor. If you're a betting person, right? If you're a gambling person and someone said, hey, you got a 90% chance here to potentially win this scratch off ticket, or if you're playing roulette, and 90% of the colors are red, okay, and there's 10% black, you'd want to bet on red, right? That 90% odds. Okay, that's kind of where I'm getting at here. And so this is another way of just looking at that. We take a look here. This is another data set. This one's from Dow Jones market data. S&P 500 performance after snapping a streak of 500 trading days without a new record. So this one's a little bit different. This is 500 trading days without a new record high. And you take a look here, the percentage higher 6 months out, 80% chance. 1 month out, 80% chance. 3 months out, 60% chance. So again, similar data set, but just a little bit different. And we still see here that 1 month and 6 months out are 80% odds that we're going to be positive, during that time that the stock market is going to be higher. Now, is it going to be 20% higher, 30% higher? Most likely no, right? Could it just be only a couple percent, 2%, 3%? Yeah, that's very possible, okay? We're not trying to predict necessarily the amount that markets are going to go up, right? What we're just trying to do is the new year has started, and let's figure out, do we want to be bullish this year or do we want to be bearish? I know there's a lot of things to worry about in the economy, okay? And there may be things to worry about that you see in the stock market, things like the equal weight not performing as well as the S&P 500. But again, the theme of this video is let's focus on the numbers, let's focus on the data and what's happened in history, and use that to help potentially give us an edge moving forward throughout the rest of the year. So long times without a new all-time high could have bulls smiling, okay? And so what we're looking at in this chart is another data set. These are all from different people, so the numbers are going to be a little bit different. The time periods are going to be just a little bit different, and the exact, percentage of all these things are going to be just a little bit different. But that's why I'm putting all of these together, right? I'm taking all of these data sets that I'm finding from this person, from that person, from this person, and I'm just presenting them all to you guys so you can use it. All right. And again, we take a look here. All right. And this is from 1950 to the current with S&P 500 returns after a new all-time high in more than a year without making one. Again, what are we seeing here? Well, 1 month out, it's positive, the average returns. 3 months out, it's positive, the average returns. 6 months out, it's positive, average returns. 12 months out, it's positive, average returns. Now, the odds that were higher 12 months out via this data set is about 73.5%, and 6 months out is 69.8%. So basically 70%. So again, we're still looking at really good odds of 6 months to 12 months out from now. With whatever data set you look at, it appears that we're getting somewhere from 70 to 80 to potentially even 90% plus odds that the stock market is going to be positive over the next 6 to 12 months. Now, these are a list of bear markets, okay, and they're defined by a 20% peak from the from the peak to the trough decline, right? And this is from 1929 to the present. Okay. And, there have been some tremendous drawdowns. All right. But when we take a look at the most recent bear market, it was basically a run of the mill bear market. Now, what does that mean? Well, here's another chart that shows that a little bit cleaner, a little bit easier for you guys to see. But the percentage decline that we had was negative 25%. It was 282 days. And the number of days to new highs was 746. So that was a very long time, right? And that was a brutal 746 days for a lot of people, right? I know tons of people just got into the market during the pandemic, okay? And then they very shortly afterwards had to deal with a bear market, a brutal bear market. But when you look at it, it wasn't the worst, okay? It wasn't the best in the sense of like the smallest drawdown, which was negative 20%. Okay, but we went down about 25%, and you take a look, it could have been much worse. Negative 58.6%, negative 49%, negative 33, negative 48. So, while we did experience a bear market, if you look here, the number of days to new highs also was kind of right in the median, right in the middle of this. Some of them lasted for a very, very, very long time, right? It took 6 years in this case here, almost 2,744 days. I mean, we're at 746. This was 2,000 days longer. Imagine if the bear market lasted another 2,000 days, guys, before we made all-time highs. I'm sure you guys would be absolutely just done with the stock market and obliterated with it and just given up on it, forever, honestly, if this bear market lasted 2,000 more days. But again, when we take a look here, and I like this data set because this goes a little bit further out, right? This isn't as focused on 1 month, 6 month, 12 month returns. This shows 3, 5, 10 years from now. And you take a look at the returns from new all-time highs after a bear market, okay? These look really, really, really good. Now, there's no averages here that totaled up, but I just want to show you guys, 3 years out, okay, looks very good. Now, there were a couple times, okay, where we did have declines 3 years out. 5 years out, there was only one time that we had a decline, and that was heading into, 07, right here. Okay. And we kind of know what happened right around then. That's when we ended up getting our great financial crisis, right? But 10 years out, guys, and this is why having that long-term mentality is so important. I talk to people about long-term mentalities, and the longest long-term, this is anecdotal evidence, by the way, but the longest long-term that I hear people talk about whenever I actually talk to people is a year. Like only 1 year. And while that may be kind of, long to your average person, when people talk about long-term time horizons, this is what we're talking about here. 3, 5, 10 years. I mean, 10 years plus is a long-term time horizon. If you're investing for your retirement, depending on your age, you're at least looking at 10 years, 20, 30, 40 years, depending on your age and when you want to retire. And, you take a look at the 10-year gains here, the lowest is 50%. Now, while that may not be, you know, insane amount of, wealth generated in a 10-year period, you look at some of these other time periods here, 396% gains, 350% gains, 377% gains. And so now the question is, what are we going to see over the next, 3 to 5 to 10 years? After we're coming here and hitting new all-time highs after a bear market. A lot of this data on this chart right here suggests that, we have good odds of seeing nice returns over the next 3, 5, and 10 years. Now, seasonality is something that I like, okay? And I told you guys I really like to focus on election year seasonality. And if we take a look at the S&P 500 election cycle, Q1 is this area right here, okay? Right, a slow start and annual trend occurs in election years, and this is where we're at right here. And after the first few dull months, we generally see a bullish trend for the rest of the year. The chart above shows the S&P 500 from 1950 to 2020 as it performed in each election year throughout the year. This can be considered a good point to see a similarly positive 2024, as history shows us that performance is likely to come in the second half of the year. And so, this is something else. So what we've been looking at is, hey, well, we're hitting all-time highs. What does the data say about us hitting at all-time highs? Using different data sets, but all kind of themed and focused around hitting all-time highs. Well, they're all generally bullish, right? Somewhere between 70 to 90% odds that the year is going to be positive 1 year later. If we switch gears and not factoring in all-time highs and just take a look at election year seasonality, we see that it's bullish. And we dive in a little bit deeper here. We've got 4 lines on the chart, okay? And the one you want to focus on is the green one. This is the election year seasonal pattern with the sitting president running. Okay, so the green line, Joe Biden is up for re-election this year. We're not going to get into politics. That's just the fact. So we're in the sitting president running election year seasonal pattern. Okay, I know it's a little bit of a mouthful, but pink line right here is going to be 2024. And look at how well it is following the seasonality. It starts off very, very strong, heading into the very beginning of February. And we typically see a peak in February and get a little bit of a decline heading into March and bottom out in that decline as we head into the beginning of April. So, while seasonality isn't a guarantee of how the markets are going to move, and they don't always have to follow those directions, I've found personally through the past 2 years that election year seasonality is one of the strongest seasonality things to factor in, to your investing and to your trading. I mean, honestly, I didn't want to buy things in October of 2022, but the midterm election year data and seasonality suggested that, hey, 100% of the time, literally 100% of the time, we're bullish 6 months to 12 months out. So I bought some stuff in October of 2022, and I wish I bought way more. Okay, and I was making videos of those days, and I was showing a lot of that seasonality, and I was saying, hey, I'm actually going to buy some stuff here, and we'll see how it goes. And since then, since that has worked, when I take a look 6 months later and the gains were just much more than I thought they were going to be, I've really focused and included these into, how I generate my thesis and my views on the market and where it can potentially go. Now, when you take a look at the February market performance, okay, just like this, where you typically see a peak around the middle of February heading into the beginning of February, we generally tend to see the same type of thing where about 10 to 11 trading days into it, it's very possible we can get a peak. Now, this isn't stuff to live or die by, right? We could peak in the beginning of February. We may not even peak in February at all. It may just keep going higher. But if we are to follow this, we can see that it's a little bit choppy heading into the first half, but we do still make new highs. And then after that, we start to see a sell-off. And that's kind of aligns with what we see here on the election year seasonality, is we start to see a sell-off in the later half of February that kind of generally tends to lead into March. And so that's kind of what this chart here suggests as well. Now, we've also had huge 3-month gains. These are also extremely bullish, okay? Your 1-month returns after a huge 3-month gain, you're positive 88% of the time. 3 months later, after a 3-month huge gain, we're positive 100% of the time. 6 months afterwards, we're positive 94% of the time. And 12 months out, we're positive 94% of the time as well. So again, this isn't so much based on all-time highs. This is just based on a huge 3-month gain where the S&P 500 had a 19% gain or more in just 3 months. That's extremely bullish. And 88% of the time, basically, we're going to see gains. I love this. I love this type of data, right? And there's more coming, guys. There's more coming too. Let's take a look at some of our old signals that we had in the back, here previously that we've covered over the past month, past 2-3 months, right? Well, what we saw in the S&P 600, okay? So this is basically your small caps. We saw the percentage of stocks at 3 months highs making new highs. All right. We saw the percentage of stocks at 52-week highs making new highs. That was a bullish signal to the market. All right. And this was kind of closer back here towards the end of February. I'm sorry, not February, but the end of November, December, right? And we see how January performance has done now that January is over. We have the Russell 2000 here, basically small caps as well. We're seeing the same thing. Percentage of stocks at 3 months highs, hitting new highs. Percentage of stocks at 52-week highs, hitting new highs. This was one of the bullish signals, all right? Now, previous data sets, right? And then we see how January performed, all right? And a lot of, that stuff was keeping us from, going short on everything, right? I know it seems like, oh, well, this is a great time to short everything. Everything's gone up so much, but that's that gambler's fallacy, right? Where let's say you're playing roulette and it lands on red, then it lands on red, then it lands on red, and it lands on red 5 times in a row. And you're like, well, it's got to go on black now. Well, it actually doesn't. Each time is unique. And so you have to keep that in mind in the market, that each time, we're seeing these tremendous rallies in the market, it is unique. And so you need to use other things besides, well, it keeps going up, it's got to come back down. You need to use other things like some of the stuff we're going over in today's video to help out, right? And so if you look at this is from December 23rd. This was another bullish signal that we had at the end of December here. And this was the percentage of SPY stocks above their 50-day moving average. It crossed above 90%. Now, since 2000, SPY has been higher 98% of the time, 12 months later. Okay, so this was a bullish signal back in December. We see that played out in January. And this is another thing that suggests 12 months later, so by December 23rd of 2024, 98% of the time, the stock market is going to be higher with a median gain of 13.8%. Now, that aligns with some of that other data that we looked at with different data sets that came to the same conclusion, saying that, hey, we're going to have 80-90% odds that we're going to be positive, and we're going to see anywhere from a 13 to 14% gain. Is it a sure thing? Nope. But as an item favorable side, for the bulls, you best believe it is, okay? And then this was another one. We had a historic bout of internal momentum. This was back in December here as well, at the end of December. For only the 4th time since 1950, the McClellan Summation Index for the S&P 500 was set to cross plus 1,500. The only precedents are the end of bear markets in 1970, 1974, and early 2010s. We've already shown you guys the data and shown you guys the numbers behind those returns whenever we see the end of bear markets heading into bull markets. And we weren't even in a bear market just now. This was just so bullish. We've had such a bout of internal momentum that it actually triggered a signal we only see heading out of bear markets. This is also extremely bullish, right? And this is, again, something that we saw at the end of December, and something that, has me going, well, hey, maybe I don't want to go all in on shorting everything right now, because we're seeing all of these, historical data sets that are bullish. right? And this was another old one here. This was from December. Want to upset your favorite bear? Tell them that when the S&P 500 gains over 10% in November and December, the returns the following year get even stronger, right? And so what you're taking a look here is that the next year returns, average returns is 19%. The median is 19%, right? And the percentage higher of times is 71%. So, this was something that was suggesting that January was going to have strong returns and going to be positive. If you take a look, there was a question mark here because this was posted at the end of December, and we saw that January made new all-time highs. All right. And, obviously we are up higher. So, this data set worked. All right. And next year, if we look at the next year data, okay, so basically, December 28th of 2024, all right, we have about a 70% chance of us being higher. All right. With some potential for double-digit gains here. So really, really good stuff, guys. I'm loving the stuff that I'm seeing out here. I'm loving all these historical data sets. Shout out to all the people that put these together. People like Ryan Dietrich. We've used a few of his charts. So many great things in here. We also have gains are common after a 20% run, but so is early weakness. So we could expect a little bit of weakness in Q1. That also lines up with seasonality. We do tend to see some weakness in the seasonality during Q1. So we'll see if that stuff plays out. But overall, we're looking on a longer time horizon of 12 months, right? And all of the data suggests that everything's going to be bullish 12 months from now. Will the Fed really cut rates with stocks at all-time highs or near all-time highs if we pull back a little bit by the time that they actually cut rates? Well, Ryan Dietrich again here has got great stuff. He found 20 times since 1980 that they cut rates when the S&P 500 was within 2% of all-time highs. Was the stock market higher a year later? 20 times. So 100% of the time, a year later, after the Fed cut rates with stocks near all-time highs, the market was up higher, right? That's great, guys. I'm loving all of this data. I hope you guys are loving all of this data. It's really helping me formulate my thesis and say, what do I want to do, right? Do I want to be bearish for the year of 2024 or do I want to be bullish, right? Is making all-time highs actually a red flag and a signal that it's a blow off top, or, could it actually mean further bullishness? And so when we focus on the rate cut thing, right, and we take a look here, we've got the last hike date, we've got the first cut date. And so, we had the last hike here in July 26th of 2023. There's a question mark there because what if inflation comes back roaring? Maybe they do hike again before they cut, but we're waiting on the first cut date, right? And what we're looking at here is going to be the yield, the 10-year yield, all right, and the change. Okay, and so if you look at the last hike to the cut change in 10-year basis points, on average, it's down about 71 basis points. Okay, the 3-month change in the 10-year yield, we actually see is on average down about 36. Okay, the 6 months change in the 10-year treasury yield is down about 91 basis points. And the 12-month change in 10-year yield is also down about 83 basis points. So, a lot of people say that if treasury yields are falling, that's going to be a little bit more bullish than stocks. And, if treasury yields are climbing and pushing up higher, that should, in a sense, theoretically be bearish for stocks. But I'm really bringing this to your attention because of bonds. All right. And this suggests that we're going to see negative moves in the 10-year treasury yield, after we get our first cut date. And, this is going to be bullish for bonds, right? Because as yields go lower, the price of bonds actually go up. So, it's looking like, over the next 12 months, it looks like things are going to be bullish for bonds. It looks like things are going to be bullish for stocks as well. I'm looking forward to the next year. What about crypto? Well, we've got the Bitcoin halving coming here, and we've got all of the reports here, basically, of the different halvings. Okay, you got the pre-halving, the first halving, the second halving, and the third halving, and Bitcoin has gone higher each time, significantly higher after a halving. We just had the Bitcoin ETF launch. It was a little bit of a sell the news event, but maybe people are now going to be starting to buy the dip in anticipation of the Bitcoin halving effect, right? And I want to share this chart right here. I don't know the guy who made this. This is a really old chart, but man, has this thing really aged beautifully. And it goes over periods when to make money. All right. And if you take a look here, 2023 was a period. It predicted that this was a period to make money, guys. It's absolutely insane. This chart is old. This thing is older than anybody I have in my family. Okay. I don't have a bunch of very old family members, and this thing right here, 2023, nailed it. And it suggests that we're going to have a 3-year cycle up to about 2026. Okay. That's going to be a period of when to make money and a good time to get into money. I've looked at a lot of stuff, and I think that it's possible that we may not get, I think that we're still in a secular bull market, right? And so secular means much longer, right? A secular bull market that's going to last to 2035. Now, I've said that before in some videos. All right. Coincidentally, I didn't even realize that till just now. It also lines up right here with this period with the peak of when to make money. But within these secular trends, you have cyclical trends as well. So you can have cyclical bear markets inside of a secular bull market. You can have secular bear markets and have cyclical bull markets inside of a secular bear market. All right. And so, I do think that over the by around 2025 is really when we could potentially see the next big bear market, or really, the next actual true bear market versus, a 10-15% correction when everybody panics if something like that happens, but it's not considered necessarily a bear market. And so, a lot of this data has been pretty bullish. I hope you guys enjoyed it. I really did. And, I enjoy finding this stuff. I enjoy sharing it with you guys. So I'd really appreciate it if you guys would like and subscribe to the channel, because I make videos like this all the time. I do a lot of technical analysis as well. And share this video with someone else. Okay. A lot of people are sharing one of these charts in the video, or two of these charts in the video. I took some time and I went through and I gathered, all of these different charts and data sets and put them all into one video for you guys. And, you can go back and refer to this video. I'm telling you guys, 6 months out from now, 12 months out from now, and see, wow, was that data set right? Was those odds correct? The 90% odds, the 70% odds, the 80% odds, the 100% odds that we went over. Did history repeat itself, and was that data set true? Or was this time actually different, right? And if it was different, what caused things to be so different, right? Did we have some type of black swan event? Or, did everything just crash for no reason, right? That's the kind of stuff you want to ask yourself, think about in the future. I'm looking forward to in the summer coming back to these data sets, looking forward to at the end of 2024 coming back to these data sets and seeing whether or not I made some of the right decisions. And hopefully you guys make some of the right decisions, whatever the right decision is moving forward for you. I wish you guys the best. All right. Don't forget to join the Discord. Right. There's a link in the description for that. Back on January 13th, we posted, as one of the swing trade ideas on DraftKings. DraftKings historically has a 100% chance of being green. In February, in past performance, it's been green 100% of the time. February just started, so that put us on our watch list. We're looking at that heading into February, and on January 13th, we talked about the falling wedge here. We had a perfect wave E retracement of a 50% retracement for wave E right here on the wedge. Very, very good signal. And you can see the stock ran up about 21% after this post here in this trade idea in the Discord. So join that, guys. It's only $10 a month. Okay. You can get access to that using the link in the description. There's been so many great ideas. And it's been really fun doing it. The Discord's been around for, a little bit over 3 months, maybe now. I think I started it in October. And, these are just some of the plays, guys. These are some of the profits that people are posting and people are getting, off of the trade ideas and off of the different analysis. So I'd love to see you guys in there. It's less than a cup of coffee a week. And don't forget, I got the newsletter. The newsletter is completely free. You can get into that newsletter and get 1 or 2 free trade ideas a week. Okay, look and see how I identify quality setups, what I use to identify quality setups. And then through that process, maybe you guys can start to identify some of your own high quality setups as well. So, that's going to wrap it up. All right. If you enjoyed today's video and want to leave a little tip or donation for all the free valuable content I do put out there, you can go to my Ko-Fi page. There's a link in the description for that. You click on buy a coffee. It's basically a way to leave a tip or donation. You can also book coaching sessions. All the Discord members, they get 20% off of the coaching sessions. I do coaching sessions all the time. We can go over day trading dynamics, swing trading strategies. You can have a Q&A session, go over something specific that you guys want to go over. A lot of people hit me up about options and different option strategies that you can do. You can leverage the shares that you own using options to get hedges and different things like that. So check out the Ko-Fi page if you guys want, and I'll see you in the next video.